Hello, everybody. I wanted to take a moment to go through a review of what happened in 2023 and take a look at what we see happening and how we should be reacting to this new year, 2024. And as you know, that's me. I've been doing this for quite a long time. This year, I think we're on 36 years of being in insurance and financial services. And going through 36 years, I've seen a lot of really good things and I've seen a lot of really bad things. Over a period of time, I've noticed trends that have helped people become successful through all different types of market trends. And I want to focus a little bit on that and how we can help you in all different types of market be financially successful. So 2023 review, there was a lot of things that really had an impact on us that I thought were pretty good. Number one, stocks and bonds had an excellent year, and I was very happy about that. Inflation seems like it's coming down. Hopefully, the 2% that the Fed is targeting is pretty close to happening, and interest rates came down substantially. So I feel pretty good about that. 2024, again, first and foremost, is a presidential election. Many people have been concerned about that. We're going to take a little bit of time to talk about that. Stocks versus money market accounts. Does it make sense to take the risk of stocks when we're getting money market accounts and CDs in the 5% range? I think that's a good question. Keeping your sanity as an investor in these types of volatile markets. I mean, last year was a pretty bland year until the fourth quarter, and the fourth quarter was just terrific. So we actually worked out well. And we're going to talk about some key takeaways that we should be thinking about for 2024. All right, 2023. If you looked at the news over last year, and news loves negative articles, they love telling you about all the bad things in the world because people will watch bad things and they can sell more advertising space. It's kind of how it looks. But if you put out the white noise and you sat back and you remained consistent, you would have found that you actually got a very good rate of return over the year. And I think that's incredibly important. So what kind of rates of return do we get? Well, if we take a look at 2023, S&P, one of the biggest indexes out there, was up 24%. The NASDAQ, mainly technology, up about 44. Dow Industrial was up 16. How did they do the previous year? Well, the S&P was down almost 20%. The NASDAQ was down 33, and the Dow was down almost 9 percentage points. Now, one of the questions people say, or one of the things people say to me is, right, the NASDAQ was down 33% in 2022, but they went up 44, so they should be up about 12% for those 2 years. No, they had a negative rate of return. And let me explain something as simple as possible. I have a stock selling at $100 a share, drops by 50%, and now it is selling at $50 a share. I need 100% rate of return to get back to ground zero, to get even with the return. So the more volatility that you have in a stock, the more it drops, the harder it is to get reasonable rate of return. So one of the things that we always look for in our investments is having stable, predictable, or funds that take less of a hit in a volatile market. And over time, that seems like it works. So if you take a look at the performance last year, there was something that you might have heard a little bit about called the Magnificent Seven, and we'll get into that a little bit more. But the performance of these funds over the past year was incredible. And if you look at the S&P, all the different indexes had a pretty good rate of return. But how did this actually break out? So if I take a look at the S&P 500 and I back out the Magnificent Seven, which is Apple, Microsoft, Alphabet, Amazon, you see them over here. Basically, the S&P 500 would have had about a 15% rate of return. Still a decent rate of return. The Magnificent Seven had a 105% rate of return. That pulled the performance when I include those seven stocks up to the 24% that we were just talking about. It was terrific. But the thing is, even in spite of that, the rates of return were pretty positive. Now, one of the questions I have is, well, why wasn't I just in those? Because of the volatility that we were talking about before. So NVIDIA is a stock, again, mainly in technology, chips and stuff like that, was up 239%. Previous year was down 50%. Now, again, over the past 2 years, great rate of return. 68% over 2 years is terrific. But if you're looking at some of the other high performance over the past year, and use Tesla as an example, Tesla was up 100% in the past year. Its 2-year return was negative 29%. I'd rather be in boring S&P 500 funds where I could participate in that. And what it means is that when we have this volatility that's out there, we're going to take less of a hit and we're going to have more of a broad range of how we're going to invest our long-term goals. I think this is a better way to do it long-term. Now, one of the main concerns people also had was inflation. And again, in the past couple of years, we had incredibly high inflation. Things were getting very, very expensive. It seems like it's getting substantially better. We're seeing the cost of everything go down. The only area that we are still rather concerned about is the cost of housing, and that also seems like it's going in the right direction. Next is one of the concerns people had were on interest rates. And there's some positive and negative things that are out there. But we had interest rates go from pretty much zero, and they've been close to zero since 2008 to, at the rates that we're seeing right now, which is over 5%. What we're seeing is, again, there's some things that are very positive. For example, if you have money in a bank account and a CD, you're finally getting reasonable rates of return. That's terrific. On the opposite side, if you're looking to buy a home, if you're looking to buy a car, if you have anything that has adjustable debt, credit cards, it is very expensive to maintain it, and the cost of that is getting worse and worse. The biggest concern I have is the cost of the national debt, and about 13% of that is coming up very soon for refinancing. And the problem with that is that we have $33 trillion in national debt. And I try to explain it like this. A million seconds is 14 days. A billion seconds is 32 years. A trillion seconds is 32,000 years. You're talking about really big numbers, and people don't understand them because you're only changing one letter. One of the biggest concerns I have for the United States long term is how much of this debt that we are basically taking on and that we're going to be passing on to our kids. So a lot of times when we're talking strategies, we're going to be talking about long-term tax strategies where we can think about if there is this debt that's out there and potentially we're going to be paying it in the future, how do we create long-term tax efficient strategies? So what's in it for 2024? A couple of things. Again, biggest concern people have is the election. Neither party can claim that a Democrat or Republican in office creates a better market for stocks. It just doesn't happen. If you take a look historically, sometimes it goes up, sometimes it goes down. It has nothing to do with who is president at that moment in time. Markets have performed well or bad under a variety of different parties. The range of markets across administrations is relatively similar. Nobody could say they're substantially better. And I think the biggest thing that we're going to be looking at is not who is the president, is what are the policies that are in effect and how pro-business are those. And a lot of this, the success of a president has to do with where's the momentum of the market going as they enter, or again, whether it's positive or negative. So a couple of things that we have here, the performance of money markets versus being in the stock market. Now, again, this is taking a look at 1990, if I was in a money market account, treasuries, or just in a aggregate stock portfolio, how much would I have if I started with $1? If I was in money market accounts, I'd have $2.22. If I was in a treasuries, a little bit more than that. If I was in stocks, I would have about $5. So I got a 500% plus rate of return over that 30-year period of time. Now, again, there is a benefit of the stability and safety of money market accounts and bank accounts. However, if I am going on a long-term investment, I do not want to be in investments that are so safe that I'm giving up rates of return. And my statement that I say on money market accounts is you will be safe, but you will go broke safely on an after-tax, after inflation basis. You will have a negative rate of return. We need to grow our money in a reasonable fashion. All right. So how do you keep your sanity in a volatile market? Now, again, if I just take a look at historically how the stock market works, S&P 500, 47% of the time, any given day, it's almost 50-50, I'll have a negative rate of return. If I'm looking at this stuff every day, it's going to make me crazy. If I look quarterly, 29%, almost a third of the time, I'm going to have a negative rate. It's going to make me very upset. Over a period of time, 78%, I'm going to have a positive rate of return. And that's why I invest in the market is 78% of the time I am going to win. Now compare it with success of Roger Federer, one of the best tennis players ever. Again, in any given time he's going for a point, he's going to lose almost 50%. If you're looking at the sets that he's playing, he loses 25% of the time, 1 out of every 4 times. But if you look at how many matches he wins, he is winning 80% of the time, very similar to the stock market. So again, I don't want to be looking at this stuff daily. I want to take a look at the big picture and see how this is going forward. And I'm going to focus on reasonably over a period of time. My odds of success in the stock market are around 78% if I remain consistent and I consistently invest through all different types of market cycles. So again, for 2024, what's the recap? election, it's not really going to have that much who gets elected, whether it's a Democrat or Republican. The most important thing are the policies, not who is the president. Inflation has continued to go down. That's what we're anticipating. Interest rates can seem like they are going down in a positive direction reasonably next year. Housing prices should normalize, which I see as being a very positive thing. And growth may ease a little bit because of some of this stuff, but we're still sensing that it should be a relatively good economy in this year, and expect markets to react accordingly, depending on who comes into office and stuff. There'll be some volatility, but long term, I think we're going to be fine. So again, just going in this, I think as we go into our reviews, I want to discuss all these specifics with you and how it impacts you and your family. But I think overall, I was happy with the returns that we got in 2023, and I look forward to a very successful 2024. Thanks again for your time. I appreciate it. See you soon.